Hi everyone! Here's what I think is the best order of where you should put your money after you've earned it, in my opinion. It's Financial Literacy Month in November, so I'm doing a series called Financial Freedom Fridays where every Friday this month I'm going to talk about a topic that gets you closer to financial freedom. So what is the best order to distribute your money after you've earned it? Assuming you have no savings and no investments, here's what I think you should do. Obviously, this isn't financial advice. Everyone's scenario is different and it depends on your income, etc., etc. What works best for me might not work for you, but don't worry, I'm going to talk about different scenarios throughout the video. Okay, first thing you should do when you get your paycheck is to fund your emergency fund. I think that this should be everybody's first step. An emergency fund is 3 to 6 months worth of living expenses saved up in a high interest savings account. Do not put your money anywhere else but a high interest savings account. Don't have it in cash, don't have it under your mattress, don't put it in a traditional savings account, and definitely do not put it in the stock market. You want to have this emergency fund for emergencies, obviously. In case you lose your job, in case there's dental expenses, healthcare expenses, car repairs, vets. The purpose of this emergency fund is to prevent you from needing to get another loan or another line of credit to pay for an emergency. That might get you into debt or further into debt. Calculating your emergency fund is super simple. Write out all your necessities and how much they cost. Here's an example that I did. Let's say your rent is $2,000, car payments are at $500, insurance is $250, student loans $100, gas $150, groceries $350. Notice how I said groceries and not Uber Eats, because contrary to popular belief, Uber Eats is not a necessity. Phone and internet is $150, and that equals $3,500 a month. So you need $3,500 a month to survive. Multiply that number by 3 or 6 months, and that gives you $10,500 or $21,000. Once you calculate your emergency fund, congratulations, the first step of building an emergency fund is done. Second thing you should do is pay off high interest debt. Some people say 5% is high, 7% is high, 10% is high. The S&P 500 generally yields between 7 to 12%, so anything above that percentage is considered high. If the interest on your debt is higher than the returns that you'll make from the stock market, you should pay off your loans first. You don't want to have a 15% loan and then only generating 7% in the S&P 500. By paying off your 15% loan, that's a guaranteed 15% rate of return. Another positive outcome for settling your debt is to build a good credit score or maintain a good credit score. We all know how important credit scores are, because if you're applying for a mortgage or a lease for your car, you're going to be approved for a lower interest rate, and a lower interest rate means more money in your pocket. I do have a 3-minute video on 2 ways to effectively pay off debt, and I'll link that down below. A third thing you should do that most people don't talk about in these videos is that there is a step between emergency fund, paying off debt, and investing in the stock market. The in-between step is to invest either time or money into learning the stock market first. If you have $1,000 to invest, I wouldn't suggest that you put $1,000 in the stock market right away, because you don't know what you're doing and you might lose all that money. You should actually either invest time to learning the stock market, or you should invest in a course that helps you understand the stock market better before you dip your toes in. So many people think that the stock market is how you get rich quick, but that is not the case. You want to be confident going into the stock market so you don't lose money. That is the reason why you're investing, is to grow your money, not lose it. Fourth thing you should do is invest in the first home savings account. This is if you don't already own a home and if you want to buy a house in the next 15 years. If you do own a home, you're not eligible for the first home savings account. The first home savings account is such a good incentive for Canadians to save for their first home. It's a hybrid between the TFSA and the RRSP. Any money you make from this account is tax-free, just like the TFSA. And just like the RRSP, any contributions you make to the first home savings account is tax deductible. That means you can claim a deduction and lower your taxable income. Once you open this account, you're allowed to put $8,000 into this account every year, and any unused contribution room can be carried over onto the next year. For an example, if you open an account this year, your contribution room is $8,000. If you only contributed $3,000, you still have $5,000 left of contribution room. For next year, you get the yearly contribution room of $8,000, and then you can add the $5,000 of unused contribution room from last year, and that's $13,000 now. The lifetime contribution room for the first home savings account is $40,000. So you cannot put more than $40,000 in this account ever. And a common mistake here that people make when opening this account is that when they contribute money in the account, they don't use it to buy stocks. You need to invest in stocks or ETFs to grow your money. Here's the catch. You cannot withdraw money from this account unless you're actually buying a qualifying home. If you cannot prove that you actually bought a home with the money you withdrew, you might have to pay taxes on the money. So make sure you're only opening this account if you're wanting to buy a home in the next 15 years. The fifth thing you should do is invest in your tax-free savings account. Unlike the first home savings account, any money that you withdraw from the tax-free savings account, you can use it on whatever you like. First home, car, any big purchase, anything. You can withdraw from your tax-free savings account at any time for any reason. If you invest in a stock for $40 and it goes to $90, the $50 profit that you make is tax-free. If you invest $10,000 and your investments grow to $40,000, the $30,000 profit is tax-free. This is honestly the best account for beginner investors because you don't have to worry about taxes. Here's the catch. Since you don't pay any taxes on your earnings, there is a contribution limit to how much money you can put in the TFSA. You can't just put $1 million in there and earn tax-free money. You can easily Google your contribution room. It just depends on the year you're born. I'll put a link to a TFSA contribution room calculator for you in the caption below. Since I'm 25, born in 1998, my contribution room is $47,000, assuming I've contributed $0 to a TFSA. That means all the money I earn from $47,000 will be tax-free. And no, capital gains and dividends do not count as contributions. Next year, in 2024, TFSA contribution rooms will increase by $7,000 for everybody. It doesn't increase by $7,000 every year. For an example, in 2023, it only increased by $6,500. Just make sure you stay updated by following me. And there are more rules to consider when you're withdrawing money. I can make another video on TFSA rules, but if you're a beginner investor, just make sure you don't over contribute to your TFSA. Step 6 is the RRSP. This is where it really depends on your situation. If you're making a lot of money and you want to pay less in taxes, the money you contribute to your RRSP is tax deductible. For an example, if you make $100,000, you have to pay taxes on $100,000. Let's just say, for simplicity's sake, that you pay 20% taxes. You would owe the government $20,000. But if you contribute $10,000 to your RRSP, you can deduct that amount from your total income, which means your income is $90,000, and 20% of $90,000 is $18,000. So you'll most likely get a return of $2,000 on your tax return. But before you contribute to your RRSP, there are two things to consider. One, there is an annual contribution limit, which is a percentage of your earned income the previous year. Just make sure to stay up to date with the contribution limits. And two, if you do contribute to your RRSP, when you withdraw from your RRSP, that contribution room is gone forever. Ideally, you only want to withdraw from your RRSP when you retire. So again, before you contribute to your RRSP, are you really not going to use that money till you're 65? And there are exceptions to withdrawing money from an RRSP, like the home buyer's plan, but again, stay up to date with the rules. And you guys, this video is oversimplified and only provides an overview of the first home savings account, tax-free savings account, and the RRSP. There are more complexities and regulations to these accounts. I might create specialized videos in the future to address them. Anyway, let me know what you guys think of the order and if you're already doing this.